For this session, we will talk about your earned capital and your recapitalization. So, in case you are trying to ask whether what particular topic in your asset section represents your earned capital and recapitalization. So, under asset section, you know this one as your items affecting your investment in equity securities, particularly your investment income. That's for your earned capital. And for your items, increasing or decreasing your investment in equity securities for your recapitalization, such as your uh, stock splits, warrants, etc. So for today, our main focus is earned capital and recapitalization. So before, in your investment in equity securities, you learn different types your uh, of your dividend income. So that can either be a cash dividend, a property dividend, it is a share dividend, a cash in lieu of share, share in lieu of cash. You can also have a scrip dividend and you can have liquidating dividend. So those are the different items of dividend you have learned under your investment in equity securities. These items, we learn them again in your earned capital. However, if under your asset we have a dividend income, here in your earned capital, we call them as your dividends. And under your sheet, you know that from your retained earnings, you will decrease your retained earnings with your dividends and you will increase it with your profit or loss to get for your ending retained earnings. Because the items of OCI will be separately presented under your shareholders' equity. So therefore, under your earned capital, we need to talk about your dividends. Okay? So let's start. What is a retained earning? So retained earning represent the cumulative amount of profits and losses, dividends, and other capital adjustments. So retained earnings may be appropriated or unappropriated. So we already know that your RE is composed of your RE beginning plus your profit or loss for the period less your dividends declared on your current period. Okay, so that is the amount of your retained earnings. Now, after we compute for your retained earnings, what is new in this particular definition is your capital adjustment. So what is that capital adjustment? That capital adjustment happens in case there are errors or there are items which you should correct prospectively or retrospectively, but particularly retrospectively. If you still remember, or if you have already discussed past 8 in your IAS 3. So, or IA 3, I should say. So, your capital adjustment happens if there are errors. So errors in the previous period that will be corrected in this current period. Normally, these errors are adjusted in your retained earnings, including any retrospective adjustments. So RE. That's why we have here capital adjustment. So your RE are affected by the following items. First, your profit or loss. Next, your dividends. Next, your other capital adjustments. Your profit or loss is a separate line item. Particularly, you discuss this one in your IE3 for your presentation of financial statements. Capital adjustments, you again discuss this one, IE3, particularly for your errors, accounting policies, and accounting estimates. So that is your standard pass fee. Dividends, of course, will be discussed here in your IA2. Next, retained earnings may be appropriated or unappropriated. So when we say retained earnings, you can classify them as appropriated or unappropriated retained earnings. When we say that the retained earnings is appropriated, it means it is set aside for a particular purpose. Normally, just like a cash fund, your retained earnings are reinvested. That's why it's called retained because it will be reinvested to the business. Since you reinvest it in your business, you try to appropriate it for a future use. So that is called a retained earning appropriated. If it is not appropriated, it is called unappropriated. Further, retained earnings is normally credit, but when it is debit, it is called deficit or accumulated losses. Retained earnings, the normal balance is credit, but if it is debit, it's called deficit or accumulated losses. Okay? So for this particular item of retained earnings, we learned that it is composed of three items: profit, losses, dividends, capital adjustment. Further, it can be classified as either appropriated retained or unappropriated retained earnings. Further, the normal balance of your retained earnings is credit, but at some point it can be debit. When it is debit, it is called deficit or accumulated losses. We go now to the concept of dividends. So purely for your earned capital, we will talk about your dividends because the other two should be discussed in your other accounting subjects. So dividends. So dividends are resources distributed to entity shareholders. So if we are the entity and we have here your shareholders, the entity has the item of shareholders' equity. The shareholders has the investment in stocks. So if the entity will declare, the entity will declare, the entity calls that item declared as dividend. The shareholder will call that as dividend income. Okay, so that's how it works. The entity will declare dividend. The shareholder will have a dividend income. Now, your dividends can either be out of earnings and out of capital. If that is dividend out of earnings, that can either be a cash, non-cash dividend, stock dividend, liability dividend. If that is dividends out of capital, then that is your liquidating dividend. So what is the concept of your dividend declaration? So your dividend declaration is based on your trust fund doctrine. So what is this trust fund doctrine? This doctrine holds that the assets of the corporation are represented by its capital stock or trust fund to be maintained unimpaired and to be used to pay corporate creditors. And we have already discussed that one. What is that particular trust fund uh, that cannot be distributed to your shareholders? We call that your legal capital. Okay? So if you still remember the concept of legal capital, which should not be impaired, but if ever it is impaired, we call it dividends out of capital, liquidating dividend. When do we have a liquidating dividend? Normally, we have a liquidating dividend if that is a wasting asset corporation. Okay. Next, who are entitled to dividends? So once we know the concept of dividend, our main question is who are entitled to dividends? And then our next question is how do we account for those dividends? We know what is a dividend. Next, who are entitled to dividends? The persons or shareholders entitled to dividends are only those shares that are issued and outstanding. Your next question maybe is what is that share issued and outstanding? The share issued and outstanding is equal to your number of shares capital issued plus subscribed share capital less treasury shares. This talks about your number of shares. So for example, so your issued shares is 300,000. Subscribed share is 20,000. And then we have your treasury shares 10,000. The most common error of students is that they think that only the issued shares has the right to dividends. Mali yun. The persons or shareholders who are entitled to dividends are those issued and outstanding. Question is, what is issued and outstanding? When we say issued, they are already issued to a particular shareholder. When we say outstanding, it's still present or it is still being held by the shareholder. So have your number of shares capital issued, of course, that is issued. Subscribed share capital, although they are not issued under the law, they have the right to dividends. Okay, perhaps you're asking me now, sir, subscribed share capital is not issued. Why do we have to give them dividends? They are given dividends because under the law, even if they are not issued shares, they can be uh, or they can still receive a share. Okay, so they can still receive a share. That's why subscribe share. They can still receive dividend. That's why they are added in your issued and outstanding. Treasury shares are deducted because this is not already outstanding. It is not held by the shareholder, but it was already repurchased or reacquired. Okay, so how do we compute issued plus subscribed share less TS? Therefore, how much is our total outstanding shares? 300 plus 20 less 10, 310,000. So this 300,000, 310,000 shares should receive the dividend. 310,000 shares should receive the dividend. Let's go now and discuss how do we account for your different dividends. So we have different dividends such as cash, share dividends, property dividends, scrip dividends, liquidating dividends. We start first with cash dividend. So there are three important dates. You already know those three important dates: date of declaration, date of record, and date of payment. At the date of declaration, you debit retained earnings, you credit dividend payable. Dividend payable is considered a this dividend payable is considered part of your liabilities, current liabilities. And on the date of payment, you have debit dividends payable, credit cash. The question is, how do we measure? If that is an ordinary share dividend, that is only dividend per share multiplied by outstanding shares. So let's say our outstanding shares as we had computed a while back, 310,000, and the dividend per share is 2 pesos per share. How much then is the amount of your dividend? 310 times 2, 620,000. So you debit retained earnings 620,000, credit dividends payable 620,000. At the time of payment, debit dividends payable, credit cash 620,000. How about a preference share? How do we compute for its annual dividend or cash dividend? That is the rate multiplied by par value of the share outstanding and then multiplied by the outstanding shares. So normally you can see 8% preference share, 100 par, and then 1,000 shares issued. So normally you can see those items or 10% preference share, 100 par, and then the total amount is just given 2 million pesos. Okay. So if that's the case, if it is par and shares, to compute for the dividend, the rate of rate of the preference share multiplied by the par value multiplied by the number of shares. So how much for the first one? 8% times 100 times 1,000. We have here 8,000. For the second one, since the total amount is given, you just multiply it to the total amount. 10% times 2 million, you have 200,000 pesos. Okay? That's how we compute for our cash dividends. Problem arises if ever we have cash dividends which must be shared by OS and PS. No problem if cash dividend is purely to OS, no problem if cash dividend is purely to PS. But what if we have a total cash dividend, it will be shared to your OS and PS. Okay? So if it's single cash dividend to a particular share type, no problem. But if it's combined, OS and PS, you need to know the type of PS. If the PS is cumulative or non-cumulative, or if the PS is participating or non-participating. So when we say it is cumulative, prior year dividends unpaid must be paid. Okay? Prior year dividend or cash dividend unpaid must be paid. If it's non-cumulative, only current year cash dividend. If it's participating, the balance after sharing the basic dividend is divided to OS and PS by virtue of their book value. And if it's non-participating, no participation to preference share after basic dividend. Okay? No participation to preference share after basic dividend. What is your basic dividend? Basic dividend is equal to your rate multiplied by your shares multiplied by the par of the shares. Okay, so cumulative, take note, all prior years cash dividend that is not paid will be paid. So we call this prior years as your arrears, cash dividends in arrears or dividend in arrears. Okay, so normally you can encounter it as dividend in arrears. So those are your prior years cash dividend unpaid. If it's cumulative, if they have a prior year, you need to pay for that prior year. But if it's non-cumulative, you only pay for the current year cash dividend. So that is equal to your basic dividend only. If it's participating, after satisfying basic dividend to OS and PS, the balance now is participated to both OS and PS by virtue of their book value. If it's non-participating, there will be no participation of PS after basic dividend. Let's try to have an example. So we have here common, uh, 2 pesos per 1 million shares. So 2 million. And then 8% preferred shares, 1,100,000 shares. So we have 10 par. Okay. 2 years dividend in arrears. Okay. So when we say 2 years dividend in arrears, 2 years had been unpaid. And then total cash dividend to be distributed is, let's say, 600,000. Okay. So first, let's try that the PS is cumulative. Okay. Ganito kasi yan, pinagsasama siya. So it's cumulative, participating, cumulative, non-participating. Non-cumulative, non-participating, non-cumulative, participating. Okay. So let's start first with non-cumulative, non-participating. Okay. So we have here OSPS total. Okay. So first, your basic dividend. You will just give your basic dividend based on our PS. Our PS basic dividend is equal to 8% multiplied by 1,080,000. Okay, next, dividend in arrears. So take note, this is non-cumulative, so we will not add the dividend in arrears. Next, non-participating siya. Since non-participating siya, guys, what we do is we give first. By the way, what is the basic dividend of OS? The basic dividend of OS is equal to your uh, rate multiplied by your rate of the PS. So basic dividend of OS or common, that is equal to rate of PS, the lowest, multiplied by the balance of your OS. So we have here 2 million, 8% times 2 million, 160,000. So we have here 240,000. So let's get first for the balance for participation. So we have 600,000 less 240. So your balance is 360,000. Next, it is non-participating. When we see non-participating, there is no participation to the PS after the basic dividend. Therefore, PS will only have basic dividend. Everything now is to OS. So total dividend given to OS, 360 plus 160, 520. PS, 80,000, total of 600,000. Okay? So, in short, guys, if it's non-cumulative, non-participating, just give 1 year PS dividend. All other else to OS. Okay? If it's non-cumulative, non-participating, give 1 year to PS. All other else to OS. Number two, let's try non-cumulative participating. Okay. If non-cumulative participating OSPS and then total. So first, your basic dividend, we have computed that already, 160 and 80,000 to 40,000. And then we have your dividend in arrears. Do you have any dividend in arrears? None. Why? Because it is non-cumulative. You will not give any dividend in arrears. Next, the balance. The balance is equal to 360,000. How will they share your 360,000? Base, sabi dyan, pag participating, balance after the basic dividend is divided to OS and PS based on the value or their book value. So we have here OSPS. The balance is 360. What is the value of OS? 2 million. Value of PS, 1 million. So we have 2 over 3, 1 over 3. So what is the value for OS? 2 over 3 times 360,000, we have 240,000. For PS, 1 over 3 times 360,000, we have 120,000. So let's get for the total. This is 400,000. This is 200,000. This total of 600,000. That is non-cumulative participating. Next, cumulative non-participating. So OS, PS, total. Okay. First, your basic dividend, 160 and 80 to 240,000. Since this is cumulative already, you place dividend in arrears. What is our dividend in arrears? You have 2 years dividend in years. So you get the 2 years. 2 multiplied by 80,000, 160,000. Sir, why is only PS as dividend in arrears? Because they are entitled to a fixed dividend per year. Normally, they are entitled fixed dividend per year. So if there is no declaration and it is cumulative, at the time there is a declaration, you should pay first the preference. Okay? So dividend in arrears, we have 2 years, 80,000 per year for PS, 160. What is the balance? What is the remaining balance? Our remaining balance is 240 plus 160, 600,000 less 400,000 is 200,000. Since it is considered non-participating, everything now is 2 OS. 160 plus 200, 360. This is 240, total of 600,000. Okay? That is for cumulative non-participating. Okay, as you can see guys, after we give for the cumulative of PS and basic dividend, all others left will be given to the OS. Ganun naman pagka participating. Ganun naman talaga pagka non-participating, all balances will be given to OS. So dito, balances to OS. Dito, balance to OS. And then the last one, we have cumulative and participating. So OS, PS, and then total. First, we give the basic dividend 160, 80, 240,000. Then we give for the dividend in arrears because it is cumulative 160,000. And then we have your balance. The balance is 200,000. It will be participated, right? So if it's participated, you get again for the participation rate based on their balances. So OS, the participation rate is 2/3, PS 1/3. So 200,000 times 2 over 3 will give us 133,333.33. This one is 66,666.67. Okay. So let's get for the total then. The total is 293,333.33, while the total is 306,666.67. So if it's cumulative and participating. Okay? So if it's cumulative, take note, dividend in arrears, they will share. Non-cumulative, no dividend in arrears. Participating, after satisfying basic dividend, they will participate out of their book value. Normally, that is the value of the shares. If it's non-participating, then no participation of the preference share after the basic dividend. It means all others remainder will be given to your OS. All other remainder will be given to your OS. Okay? So that if ever our total cash dividend is for OS and PS, you need to divide them based on the type of PS, whether cumulative, non-cumulative, participating, or non-participating. Next, property dividends. So for property dividends, you need to know whether the property dividend declared is under PFRS 5 or not under PFRS 5. So what are the items under PFRS 5? PPE, intangibles, investment in associate, not under IFRS 5, for example, inventories, financial assets. Okay, so for property dividends, take note, it is important for us to determine whether it is under PFRS 5 or not under PFRS 5. So there are four important dates now in a property dividend, unlike in a cash dividend that you only have three important dates. So the first important date is the date of declaration. If it's not under PFRS 5, it is measured at fair value. So you debit retained earnings, you credit dividends payable. If it's under PFRS 5, it is the lower of carrying amount of or fair value less cost to sell. So debit non-current asset held for sale, credit non-current asset. Okay? Or we can also have non-current asset held for distribution. Okay? If you're done with your IA3, PFRS 5, non-current asset held for sale. So the rules of those non-current asset held for sale will follow if it is a property dividend. And under PFRS 5, the difference is considered impairment loss. So for example, so the carrying amount of the property is 800,000. The fair value is 700,000. The cost to sell is 20,000. So if that is under PFRS 5 or not PFRS 5. If it's under PFRS 5, you debit non-current asset held for sale or held for distribution at the lower of carrying amount of NFVLCTS. So carrying amount and then FVLCTS, what is the lower amount? So 700 less 20, we have 680. So the lower amount is 680. You remove now the non-current asset, which is equal to 800,000. So we have a difference amounting to 120,000. It is treated as impairment loss. Sir, what if the fair value less cost to sell is, let's say this is 900,000. If that is 900,000, so carrying amount is 800, and the fair value less cost to sell 900,000 less 20, so we have 880. You measure it at lower, so the lower is 800. So we have your non-current asset held for distribution, and then non-current asset 800. So in short, there's no impairment loss. So it is always lower between them. So laging impairment loss lang pagka under PFRS 5. Okay? Laging impairment loss lang yan. Kasi pag mas mataas na yung FVLCTS, edi at the carrying amount, walang impairment loss. Pero pag mas mababa, may impairment loss. So in short, you will never have a gain. Okay? If under PFRS 5, no gain at date of declaration. Okay? It's always loss. If it is not under PFRS 5, you debit RE and you credit dividends payable at what amount? At the amount of the fair value. So what is our fair value? Here it is 700,000. So 700,000. Here it is 900,000. So RE dividends payable 900,000. It's easier here in your not under PFRS 5, just measure it at fair value. While under PFRS 5, measure it at lower, take note lower of carrying amount or fair value less cost to sell. Please do not forget to compare those two items. And if ever there is a difference, we call it as impairment loss. Here, there's no impairment loss because the lower is your carrying amount. Date of record, yes, no entry. Date of reporting and settlement. So every time there is in between date of reporting, so normally that is your year end, and on the date of settlement, you will make another entry before the date of payment. Okay? So on the date of reporting and date of settlement, if that is not under PFRS 5, you remeasure at fair value. Any increase or decrease is affected in retained earnings. Under PFRS 5, you still measure it at your lower of carrying amount or fair value less cost to sell. So additional impairment loss or reversal gain. So here you compare it to your original CA. So our first example is that this is the carrying amount 800, the fair value is 700, the cost to sell is 20,000. Clear? Okay. So assuming on the date of reporting, we have the following amounts. The fair value is, let's say, 750. The cost to sell is still 20,000. Okay. If not under PFRS 5, you should only account for the increase or decrease on your retained earnings. So you just compare the new fair value. You compare the new fair value to your old fair value. So the new fair value now is 750. The old fair value is 700,000. So there is an increase. So you increase your dividend payable because there is an increase 50,000, and any increase or decrease, it is RE. So RE 50,000. Okay? Next. You come for your under PFRS 5. So I'll just erase this second example, okay? So under PFRS 5, if it's under PFRS 5, you compare the carrying amount. Initial carrying amount is 800,000, okay? So original carrying amount. And you compare it now to your FVLCTS. Your new FVLCTS is 730,000. So the lower is 730,000. So what is your non-current asset held for distribution before 680? Okay, 680. And the lower between them is 730. So there is an increase of 50,000. So what do? We increase your non-current asset held for distribution by the amount of 50,000, and we call that as a reversal gain amounting to 50,000. Okay? Reversal gain amounting to 50,000. Just remember that your cap amount is your original CA. Nasabi naman natin kanina yan. Doon sa una pa lang, never kailangan tumaas yan sa CA. So in short, pag yung FVLCTS na yan is more than, so ang more than yan, let's say, ang na-compute mong FVLCTS is 830. Anong lower? 800. So tataasan mo siya ng 800. Yun na yung amount ng reversal gain mo. Okay? Yun naman yung amount of reversal gain mo. Kasi yung cap mo lagi is yung original CA. Compare your FVLCTS always on your original CA. I know you know that one based on your PFRS 5. Just compare always. Okay? Date of reporting and date of settlement. So we're done with date of declaration initially. Date of reporting, okay na rin. Date of settlement, ganun lang din yung gagawin nyo. You need to compare it again on your fair value for your not under PFRS 5 and FVLCTS for your under PFRS 5. We go now to your date of payment. For your date of payment, if that is not under PFRS 5, you debit dividends payable, you credit non-cash asset. The dividend payable is at fair value, the non-cash asset is at cost. Okay. So in our example a while back, the dividend payable now, the fair value is 750,000. And the cost of your non-cash asset is 800,000. Therefore, the difference is considered loss. Okay? The loss, 50,000. If it's under PFRS 5, the dividend payable is a declaring amount versus FVLCTS and the non-current asset held for distribution at carrying amount. Okay? At carrying amount. So this one. So sir, where did we get your dividends payable? Because under PFRS 5, aside from reclassifying it, you will need to recognize this one. Okay. So you just need to recognize RE dividends payable together with your non-current asset held for distribution. That's why there's still a dividend payable here. Your dividend payable initially is still in your under PFRS 5, always at carrying amount versus FVLCTS, while not under PFRS 5 at fair value. And now, at the date of payment, it is treated as gain or loss. Okay? So ingat kayo sa property dividends. You need to determine whether if it's under PFRS 5 or not under PFRS 5. Okay? Four dates to take note. Date of declaration, date of record, date of reporting and settlement, and date of payment. We have your cash or non-cash alternative. This is your share in lieu of cash, cash in lieu of shares. So if that is the case, under the standards IFRIC 17, it provides that you need to consider both alternatives and you need to associate the probability of selecting each alternative. In short, at the date of declaration, you already record what particular alternative will be chosen. Okay? So you already record what is the amount of your chosen alternative because you already associate the probability. When we say probability, more likely than not. So what is more likely to be chosen by them? So you already record. If it's cash, you follow the rules on your cash dividend. If non-cash alternative, you follow the rules of your property dividend or your share dividend. We go now to your share dividends. For your share dividends, you need to look into the type of share. If the share dividend is a new issuance of shares, this will affect your retained earnings, and then we have your share dividends payable. If a share of other entities, this is considered as a property dividend. If it's treasury shares, it affects your retained earnings, shares dividend payable, but treasury shares. What's the difference? In your new issuance of shares, in your new issuance of shares, it is either accounted at par or at fair value. Share of other entities, it is measured at either fair value if it is not under PFRS 5. If it's under PFRS 5, then we measure it at fair value less cost to sell. Okay? So if under PFRS 5, in short, associate, not under PFRS 5, PFRS 9 yan. Next, we have your treasury shares. You will measure this one at cost. So it is important for us to know the share dividend. New issuance of shares, because there is a different treatment and the measurement. Share of other entities, it is considered a property dividend and you already know the treatment. Treasury shares, because it has a different treatment and measured at cost. Let's start first with your share dividends new issuance. So it is a dividend paid in the form of entities' own shares. So the date of declaration, retained earnings, share dividends payable. Date of record, no entry. Date of payment, share dividends payable, credit share capital. However, for your share dividends new issuance, you need to determine whether it is a small dividend or a large dividend. If it is small dividend, less than 20%. So for example, 10% share dividend is declared. Okay. If large dividend, 20% or more, okay, equal or greater to 20%. So for example, 25% share dividend is declared. So how to compute total share outstanding, issued and outstanding, you already know how to compute that, right? Multiplied by your share dividend percentage, that will give you your share dividend. Okay. So if that is a small dividend, it is measured at fair value or par value, whichever is higher. Of course, it is always fair value that is higher. Okay. So it is measured at fair value. While in your large dividend, it is measured at par value. So let's have an example. So our total issued and outstanding shares is 310,000. Our first example a while back. We have total issued and outstanding 310. So let's have a 10% share dividend. The par value of its share is 15, the fair value is 20. Next, we have 25% share dividend. The par value is 15, the fair value is still at 20. Okay. So the first one, at the date of declaration, we debit retained earnings, we credit share dividend payable. Okay. So, your retained earnings is equal to the fair value kasi nga higher siya, 20, multiplied by 310,000. We have 6.2 million. The share dividends payable should be recorded at par, so 15 times 310,000. 4,650,000. And then we have your share premium, the difference, 5 times 310,000. 1,550,000. Okay? Take note, share dividend payable always recorded at par. So if that is a small dividend, the excess of fair value over the par value is share premium. Date of record, though entry, date of payment, you just remove your share dividend payable, which is 4,600,000. Okay, we did not compute the amount of shares. It should only be 10%, right? So 31,000. Sorry, I forgot to multiply it to the 10%. So we multiply it to 31,000, 31,000, 31,000. So this is 620,000. This is 465. This is 155. Okay. So at the time, share dividends payable 465,000, we credit share capital 465,000. Next, we have a 25% share dividend. So 310,000 times 25%, 310 times 25%, your total share dividends is 77,500. So you debit RE and then share dividends payable at par only. At par, so there's no share premium here because it's large dividend. So the par is 15. 77.5 times 15, we have 1,162,500. And at the time of payment, share dividends payable, share capital, 1,162,500. Okay? So small dividend less than 20%. Large dividend more than or equal to 20%. It is to be measured at fair value or the par value, whichever is higher for small dividend. Large dividend always at par value. And there is a share premium in small dividend, no share premium in your large dividend. Next, share dividend treasury shares. This one should be measured at cost. So no problem here. Just debit RE, credit share dividend payable TS. So it is at cost. And then at the time of payment, share dividends payable TS, credit treasury shares is still at cost. So no problem on your measurement. It will remain at cost. Liquidating dividend. So for the amount of your liquidating dividend, it is debit to capital liquidated, credit to dividend payable. As you can see, the debit now is not retained earnings, but the debit is a capital liquidated. So that capital liquidated is a deduction from your shareholders' equity. At the time of payment, debit dividend payable, credit cash. So no problem here in your liquidating dividend. Just debit capital liquidated instead, not retained earnings. Okay? So this is a type of a dividend, although payable in cash, but it is not considered out of earnings, but it is considered out of capital. Therefore, it decreases your shareholders' equity. We go now to our last topic for your shareholders' equity, that is your recapitalization. So recapitalization occurs when there is a change in the capital structure of the company. So the old shares are canceled and the new shares are issued. So some examples are change from par to no par or no par to par. or reduction of par value or stated value. And we have also your share split, split up or split down. Okay, so let's first discuss your change from par to no par or no par to par. So in your change from no par to par or par to no par, you remove the old capital. So this is the old capital. And then you make an entry for your new capital. So the balancing, if debit, it is retained earnings. If credit, share premium recapitalization. So for example, if it's par to no par, so we have ordinary shares, 100,000 shares. Par is 10 pesos per share. And the share premium total 300,000. So 100,000 times 10, we have 1 million. So this is par. You will now go to no par. Since it is no par, it is hard for you to measure now the amount of your share premium because it is no par. So since no par, let's say uh, it's still 100,000 shares, but it has no par value. So you remove the ordinary share capital, 1 million. You remove the share premium, 300,000. And since it's no par, it will still be 1.3 million. There's no, there's no balancing. But if that is no par to par, so for example, you have ordinary shares, 1.3 million. You will now go to par. So this is 100,000. You will now go to par with a 5 peso per share par. So from no par to par, you remove the ordinary share capital, which is no par, 1.3 million. And then you record now new ordinary share capital at the par. The new par is 5 times the number of shares, 100, 500,000. We have a balance. The balance credit, share premium, recapitalization, 800,000. Okay? As you can see, we just recorded a change from par to no par. If the balancing figure is debit, then retained earnings. If credit, share premium. How about if we change the par to 15? Okay, so the par is 15. So OS capital, the no par is 1.3 million. And your OS capital at par, which is 15 times 100,000, we have 1.5 million. So kulang naman yung debit natin, di RE yan, 200,000. Okay? So change from par to no par, no par to par. Okay? Just remove the old capital. You make an entry to your new capital, the balancing, debit, retained earnings, credit, share premium recapitalization. Next, reduction of par. For reduction of par, whatever is the reduced par will be placed on your share premium recapitalization. So for example, we have ordinary shares 100,000, P10 par, 1 million. We will reduce now the par. We will reduce the par to 8 pesos. So we reduce it to 2. So 10 less 2, 10 less 8 is 2, multiplied by 100,000, so 200,000, place it to your share premium recapitalization. This is quite easy. You just need to reduce the amount of your OS based on the reduction of par. So from 10 to 8, so we have 2 times 100,000, 200,000. And then share split, whether that is split up or split down, memorandum entry. But take note of the effect of your share split. Effect of your share split. Of course, it will increase as the number of shares if that is split up. If it's split down, it decreases the number of shares. Next, as to par value, the par value in split up will decrease. The par value in split down will increase. Okay? So, what are the shares that will increase or decrease? When we talk about the shares, these are your uh, issued shares. What else? Subscribed shares. your treasury shares. So take note of the effect. If ever there's a split up, your issued shares should increase, subscribed shares should increase, your treasury shares should increase. All shares. If ever there's split down, edi decrease naman lahat yan. So ingat lang kayo dito. Although it is memo entry, ang pag-iingatan nyo dito is yung total issued and outstanding nyo. Kasi baka mamali kayo ng pag-compute. Hindi lang yung issued ang tataas or bababa, including all other shares, whether that is subscribed shares or treasury shares. Okay? So please take note of your share split. So for recapitalization, we have only changed from par to no par or no par to par, reduction of par and share split. It is quite easy, just know the rules. Let's have a quick recap on your dividends. So for your dividends, we have either dividends out of earnings and out of capital. For out of earnings, you have your cash dividends, non-cash dividends. We also have your scrip dividends, and we have your share dividends. For cash dividends, no problem. Just measure it at the amount of cash dividends. But take note, if we have a preference share, take note of the rules. If ever it is non-cumulative, non-participating, non-cumulative, participating, cumulative, non-participating, and cumulative, participating. For non-cash dividend, determine if it's under PFRS 5, or not under PFRS 5. Why? Because if it's under PFRS 5, FVLCTS, or carrying amount, whichever is lower, not under PFRS 5 fair value. Scrip dividend, the amount based on the scrip or the liability, and we have your share dividend, which is now based on your small or large dividend. Small, less than 20%, large, more than or equal to 20%. This is fair value or par, whichever is higher. Large is always at par. So there is share premium here, no share premium in your large dividend. For cash or non-cash alternative, always take note at the time of issuance or at the time of declaration, you should already know whether that particular shareholder will get the cash or the non-cash alternative and either account it based on those. So that's it for the end of our shareholders' equity, earned capital, and your recapitalization.